America has been downgraded, and the dollar, for all the pushback it faces, remains the world's default currency. But America's dominant position is now under stress.
So this is huge. A credit ratings agency just downgraded the US. This is so rare that this is only the second time in US history that this has ever happened. The last time was in 2011, and it was a huge deal. There are now only 9 countries in the entire world that have the perfect AAA credit rating score, but the US is no longer one of them.
Let's get right to that top news. Fitch has indeed downgraded the U.S. government's credit rating. Now, this is only the second time it's ever happened. The first was in 2011. It was historic then.
Fitch Ratings downgraded the U.S. debt rating from a perfect AAA to a AA+. The effects already being felt. The 3 major indexes were down by mid-morning. Global stocks also fell Wednesday.
And as a result of that, the stock market lost 7% in a single day on Wednesday, which is just insane when you remember that for context, the market is supposed to go up 8 to 10% in 1 year, and we just lost 7 in a single day. But the question is, what did the US do to deserve this downgrade? Fitch cited a couple reasons, but really the biggest reasons was because of debt and because according to them, the US is no longer as trustworthy as it once was. Fitch believes that US standards have been going down for the last 20 years, and here's what they said in their official statement about why they did this. There has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. So there's a lot to unpack there, and the real question is, what does this actually mean in layman's terms? Why is this credit rating so important? Why did the stock market react so badly? How does this affect the US as a country and consumers and investors as a whole? That's what I want to explain in today's video, so let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the downgrade. So I just got back from Disneyland literally a couple hours ago, and I'm super happy, and I'm like, what are we making a video about this week? And then I read, economy's on fire. Stock market collapses and loses 7%.
US credit rating downgraded.
I leave for 1 day and everything falls apart. But let's get into this crazy story, starting with what this credit rating is and why it's useful. Think of this credit rating like a report card for the entire world. Except instead of students, we have countries. Every country has its own report card or credit rating, and its strength is measured by how well the government is run and the strength of its economy. The better run the government is, the higher the grade. Except instead of A through F like we used to get in school, this is a little more complicated, but not by much. Here's the breakdown of all the possible grades you could get, starting with D, then C, double C, triple C, and so on and so forth, with the best grade at AAA. This is where the US used to be. We were straight A students, but we were recently downgraded to AA, which is still considered really good because it's still investment grade. But we're now 3 grades away from being speculative grade, which is sort of like being a D student, definitely not where we want to be. But why this is important is because of money. Who would have thunk it? Everything revolves around money. The US is seen as a beacon of safety where other countries park their money inside of because we're straight A students. We know what we're doing. And specifically the way it works is countries buy our treasuries or government bonds. $7.6 trillion worth to be exact is how much money other countries have invested with us, with Japan, China, and the UK being the biggest investors. So this report card is sort of like our reputation. It's a statement to the rest of the world that we have never defaulted on our debt, and we've always paid our investors the interest that we owe them. So if the US has never defaulted on its debt, then why did it get downgraded? There's 3 main reasons why this happened that I want to share with you, and then I want to show you how this personally affects us, because unfortunately, there is a price to pay. Now, just because the US is getting itself into deeper and deeper debt and had its credit rating downgraded doesn't mean you have to as well. It's now more important than ever to keep as much of your money in your wallet as possible, which is also why I've been using an app called Rocket Money. Rocket Money is an all-in-one finance platform that helps you save more and spend less. The personal finance manager allows you to manage subscriptions, lower your bills, monitor your credit score, and helps you build your savings all in one place. And there are three main features of the app that I think are really useful. Number one, Rocket Money safely and securely identifies any recurring charges and cancels unwanted subscriptions for you with just a tap. You never have to get on the phone yourself or try to find the cancel button. They do all the hard work for you. Number two, just by uploading a photo and tapping a button, Rocket Money can negotiate your bills for you, anywhere from internet service bills to cable and phone bills, and that's why the average Rocket Money member saves roughly $720 per year, or up to 20% off their bills. The app pays for itself. And number three, Rocket Money gives you a clear picture of your net worth, including your cash, debts, investments, retirement accounts, crypto, collectible items, and shows you how it's trending over time. That's why Rocket Money is trusted by over 5 million members and counting. And you can try it out for free and unlock more features with premium by going to rocketmoney.com/Andrei or by clicking the link below in the description of this video to start saving as early as possible. Thank you, Rocket Money, for sponsoring this segment of the video, and now let's get back to it. So here are the three reasons why the US was downgraded.
Fitch says this downgrade does not happen overnight. America's position has been gradually deteriorating. And broadly, there are three problems: erosion of governance, rising government deficit, and high levels of debt.
Now, erosion of governance specifically refers to something called a debt ceiling, which the government has to raise in order to approve increased spending. Now, the debt ceiling is extremely important not just to the US, but to the rest of the world, because as part of that budget, that includes interest payments on the bonds that other countries have with us. Unfortunately, the US likes to wait until the very last possible second to raise the debt ceiling and approve more spending. To the rest of the world, this shows a complete and utter disrespect to not only the US citizens and the government workers, but also the international investors and bondholders who expect to get paid on time. Imagine being a blue chip dividend investor and you were waiting to get paid, but instead you saw the board of directors break out into a fist fight arguing over how they're spending way too much money on dividends. Now, you know the real reason they're fighting is because, wink wink, they want to get their bonuses first. And if you saw that, you'd get pretty upset, and in some cases, you might even get worried that you might not get paid on time. And that's an example of an erosion of governance. Of course, the Secretary Treasury disagrees with this assessment, but it makes sense why the government would disagree. But that's totally predictable, because that's like asking a student to grade themselves. No one's gonna be like, yeah, I'm definitely a D student. I deserve a D. The second and third reason why the US got downgraded is because of government deficits and higher levels of debt. And if you look at the historical US debt level, you'll see the country now owes more than $32 trillion, and the debt keeps growing at an unsustainable level, especially when you factor in interest rates. And that's because higher interest rates affect not only the consumer's ability to borrow money, which is becoming more expensive for us, but also the entire country. Because the way we really pay off our debt is we take a credit card and we use it to pay off all of our other credit cards. That is the easiest analogy to understand, and that's why we have never defaulted on our debt, because we can just borrow more. And we can do that without affecting inflation too much, because we also have the ability to export excess US dollars to other countries because they need dollars to buy their energy, aka their oil, aka the petrodollar. And it needs to stay the world reserve currency, and part of doing that means getting good grades on your report card. But the problem is, when interest rates are high like they are right now, more of that money goes towards higher interest payments, which increases our debt, which only perpetuates this endless cycle for the need to borrow money. And that's the real reason for the downgrade. But now the question is, how does this actually affect consumers and investors? The good news is that this downgrade is a very small amount. Objectively speaking, from AAA down to AA still leaves the US as one of the safest countries in the world to park your money. But if in the future we have a president who's running on the platform of being financially responsible and paying down the debt, I don't know why I thought of Warren Buffett that time, but if they wanted to be responsible, then this does increase the odds of higher taxes in the future. But because it's politically unpopular to do that, the US usually defaults to just printing more money because that's way easier, but it also contributes to more inflation and, of course, higher debt. But yes, in the future, it does slightly increase the odds of higher taxes. Another side effect of all of this is that it increases the cost for the country to borrow money. But hold on a minute, Andrei. If the US government disagrees with this agency's new rating, why would it subject itself to paying all these higher rates if it could just borrow more money from itself at lower rates, right? That's a good question. And the answer is because it can't. When the US wants to borrow money, it creates new bonds. Those bonds' interest rates, or yields, are tied to federal fund rates. Now, this means that when a country's risk goes up, like the US just did, the country has to compensate investors by paying a higher interest rate because they're theoretically taking on more risk. But that's exactly how the stock market works. That's why when someone asks, Andrei, talk about this dividend stock that's like 10% dividend yield, they're tempting you, and that's how they get you. They pay you a higher interest rate because the truth is that stock is a lot more risky, so they have to compensate for it. Now, fortunately, this downgrade is extremely small, and if you look at any of the bond charts over the last few days, you can see that bond interest rates did go up, but only by a very small amount. So yes, on paper, it does look like it now costs the government just a little bit more money to borrow more, but despite this downgrade, no one actually believes that the US would ever default on its debt and not pay its bondholders around the world just because one credit ratings agency said so. Another direct downside we all feel right now, though, is volatility in the stock market. Now, I'm filming this video on Wednesday, but by the time you're watching this, the stock market could have recovered or it could have fallen more. Because on Wednesday, it fell 7%. But that's because that's the initial reaction of investors selling off their stocks because they're panicking and they don't fully understand what any of this actually means. In the short term, this doesn't mean much at all. In the long term, it means we need to get our act together because our reputation matters. If it didn't, the rest of the world wouldn't want to buy our fun coupons. And if no one wants our fun coupons and we have more at home, that means hyperinflation, which means paying 10 times more for things like milk, eggs, rent, chicken, things like that. So keep an eye out, have a wonderful rest of your day, smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday, and apparently now sometimes a Thursday. I'll see you soon, bye-bye.